Okay, so why does this classification between employee and independent contractor really matter? Well, part of it is business expenses are deductible, but personal expenses are non-deductible. We know that, right? That's not news to us. But obviously, this creates incentive to shift personal expenses to business expenses. And let's go through a simple example. Sally reads the Wall Street Journal every day. It costs $100 a year, which it doesn't cost more than that. If this is personal, then the after-tax cost is still $100 because, of course, you generate no tax savings because you can't deduct it. Whereas, let's assume she's in a 28% tax bracket. Now, suddenly, if she can deduct that cost, the after-tax cost is only $72. And so, as a result, Sally says, oh, well, the journal's sent to my office because it's a business expense. So when we think about this situation between, an employee versus an independent contractor, let's assume both taxpayer A and B, they're both CPAs. Taxpayer A is an employee, taxpayer B is self-employed, and A and B both subscribe to the Journal of Accountancy, which is the journal that is published by the AICPA, and it's $100 a year. And again, I don't even know what it costs. A has two options. A can have their employer pay for the Journal of Accountancy, or they can pay for it. But B only has one option. B pays for the Journal of Accountancy because B doesn't have an employer; they're self-employed, right? So they are the employer. Well, as long as A's employer and B can establish that the Journal of Accountancy subscription is an ordinary and necessary business expense, which if they're accountants, they're CPAs, they almost certainly can, then the cost will be deductible. Now, it's probably not taxable to A, because remember, A's employer is paying for this. But it's probably not taxable to A because this is a working condition fringe benefit. And if you recall, we covered fringe benefits back in chapter 5, I think. Yeah, chapter 5. If A pays for the Journal of Accountancy, so not A's employer, but A as the employee pays for it, this is now a non-deductible, unreimbursed employee business expense. That will be true through 2025 as part of the Tax Cuts and Jobs Act. They eliminated the unreimbursed employee business expense deduction. Now, outside of that window, so 2017 and prior, and presumably 2016 and later, but we don't know, these would be itemized deductions subject to the 2% of AGI floor. So, and when we get to itemized deductions, that'll make more sense to you, but obviously, if A doesn't itemize, if they take the standard deduction, then it's not worth anything anyway because they wouldn't be able to take this deduction. And that's really looking at it from largely the employee's perspective. If you look at it from the employer's perspective, there's, of course, a whole multitude of issues associated with the classification of employee versus independent contractor. Everything from do you have to, apply the benefits that are available to employees to that person? Do they get health care? Do they get pension, et cetera, et cetera, et cetera? So, there's a number of reasons that you may want a particular classification. But hopefully what you're gathering is that it's really supposed to be based on the facts and circumstances of the situation. Okay. So obviously the current status of unreimbursed employee business expenses mean that virtually all business expenses are non-deductible by employees. And so you would have to argue that there'd be a strong incentive to shift to have employers pay for those items. So let's go back and make sure we understand this because I don't want you to get confused. It could be that A pays for the Journal of Accountancy, but then requests reimbursement from their employer. So you can see that what's happening is A is just a conduit for the money, whereas A's employer is actually bearing the burden of the expenditure, and that's where the deduction would lie. In situations where that's not the case, where the employer is not picking up that charge, it becomes a non-deductible, unreimbursed business expense. So as I mentioned, this means that taxpayers will try and classify all expenses as business, or at least for the production of income, right? But the code and Congress, who writes the code, try to find ways to stem our ability to shift the character of personal expenses to business expenses. And this is done in a number of ways, and sometimes they're fairly complex, but sometimes they're pretty simple, right? Like, no, you just can't deduct that. Entertainment being a great example of that. And there are things that are in between, right? Mixed motive. So there might be a business motive, but there could also be a personal motive. And so, what types of measures can we place on those? And sometimes they're strict. So, for example, uniforms. Now, again, uniforms would only be deductible by a self employed individual now. But the case law largely surrounds employees. So, we're going to talk about these in these examples more from an employee perspective. Just bear in mind, of course, that they are not deductible because unreimbursed employee business expenses are no longer deductible. But let's say it's uniform. So Felicia's a newscaster. And so for the sake of this example, we have to decide that she's a self-employed newscaster, which seems unlikely given the ABC rule, but whatever. She's required to wear fashionable suits for on-camera appearances. Now, normally, Felicia would just dress in yoga pants and t-shirts, right? She's totally chillaxing. But if the suits can be used ordinarily, meaning there are other people who could wear those, and that would be okay, then those are non-deductible. And it's not even relevant whether Felicia does wear them for ordinary use. It's whether or not some reasonable person could do so. You can compare that to Officer Friendly, who's a police officer and is required to purchase her own police uniform. Well, a police uniform is not adaptable to ordinary use. In fact, it's probably against the law to wear a police uniform around when you're not actually in law enforcement. And so that would be eligible to deduct. But since police are almost exclusively employees, that would render that non-deductible. But under the uniform rule, at least, it would be deductible. All right. So more mixed motive expenses, and these are dealt with a less strict approach and more of a rule-making approach, which means that they're probably going to be complex. So travel and transportation for business purposes should be deductible, right? As long as it's ordinary, necessary business use. Travel and transportation, there's no doubt that businesses incur those kinds of costs and they should be deductible. However, it's clear that commuting costs are considered personal costs and therefore they are non-deductible. So, a lot of debate comes down to whether something is a commuting cost or a non-commuting cost when it comes to transportation. So the next thing we need to do is break down transportation and travel into two segments. They're actually two different things. So transportation is the cost of getting a taxpayer to and from a business site. For example, bus mileage, tolls, parking, taxi, when they are not away from home travel. So this means that they're in their general work home vicinity and there's a pretty good chance they're just coming home at the end of the day. Travel, on the other hand, represents those costs plus airfare, meals, lodging, and incidental expenses when you are traveling away from home. And again, for both instances, both transportation and travel, there needs to be a business purpose for that, or else it's not deductible because then it's just a personal expense. Now, we need to note the difference between transportation and travel because the rules around what you can deduct are different. So let's start with transportation and recall this is a not away from home situation. So the cost of getting a taxpayer to and from the business site, this is typically commuting versus non-commuting argument. That's really where this is based, right? So is your drive to the office commuting or is your drive to the office trying to get to your business site? And we'll go through some examples of that so that we can help understand what the differences are. Very commonly, mileage is used. So the IRS, as a convenience to taxpayers, said, well, we're not going to make you track your actual costs of transportation, right? You don't have to figure out the oil and gas and repairs and maintenance and depreciation on your auto. We'll just let you take a per mile mileage charge as a business expense. So in 2022, the mileage rate was 58.5 cents per mile through June 30. And then because, as you recall, the price of gas went up so high, They bumped that up to 62 and a half cents for the rest of 2022. Right now for 2023, it is set at 65 and a half cents per mile. And just so you're aware, they do not typically change the mileage rate during the year. It has happened before, so it's not unprecedented, but it is uncommon. So Mr. Hand drives 14 miles from his house to his office in Ridgemont. And then at noon, he drives 11 miles from Ridgemont to Lincoln to attend a business workshop. And then at the end of the day, he drives from Lincoln to his home. So since this travel is not away from home, the kind of general rule is, well, then it's not deductible. However, we need to make an argument here for a transportation deduction. So as an example, Nathan notices a really nice new hotel across the street from his employer. One evening, he decides to stay at the hotel rather than drive home. Clearly, there's no need for him to be away from home, and so that would be a non-deductible expense. Okay, here we go. So let's track Mr. Hand's travel through each step. So first, we've got from home to Ridgemont, right? So we're going from our home to our regular job. That's generally not going to be deductible, right? Then the IRS graphic here shows that that is actually never deductible. And then you've got your drive from Ridgemont to Lincoln. Well, remember, Lincoln was a temporary work location. It wasn't a second job. It was a temporary location. He had to go there for some sort of business meeting. Well, that would be deductible then. And then the last part was the drive from his temporary location back to his home. And that, as you can see, is deductible if you have a regular or main job at another location, which Mr. Hand does. So what you have is two legs that would be deductible, or one leg that is not deductible. That is his commute. All right. So again, lots of taxpayers will use the standard mileage version to charge off those costs. That's total business miles times whatever the mileage rate is for that period. And again, usually an annual rate. The alternative is you can choose actual. So you would add up gas, oil, tolls, parking, repairs, depreciation, insurance, licenses, everything else. You add them all up, and then you figure out, you prorate those expenses based on business mileage usage versus total usage. Very much like we did with the rental homes. You can choose whichever you want. You can choose the standard or actual method. There are some restrictions. So, of course, you must own or lease the car yourself as the taxpayer, right? This can't be a fleet car. It can't be your business's car. It's got to be owned or leased by you. You cannot be with a fleet, 5 or more. Then you have to use actual. You can't switch to mileage if you took bonus or 179 in that first year, right? So if you took those, then of course you accelerated those deductions, and they're not going to let you now switch to the standard mileage method. And if you want to use standard mileage for a car you own, you have to choose it in the first year of the car. But then in later years, you can choose standard mileage or actual expenses, whichever one. Now, if you choose the standard mileage system, you actually are still required to adjust the basis of the car when you sell it. So, for example, you charge off all these miles at 63 cents a mile, whatever it might be, and then you sell the car. Well, in theory, you haven't reflected any depreciation against that car, and so its basis is what you paid for it. Well, wait a second, right? Part of that mileage deduction is intended to include depreciation costs. And so what they do is make you adjust the basis of the car, and they issue what that mileage rate is each year. And so in 2021 and 2022, you would need to deduct depreciation from the basis, not an additional deduction on your income tax, but from the basis of the car at 26 cents a mile. So let's do an example. In 2022, Cookie drives her car 8,000 miles for business and 2,000 miles for commuting, and then 3,000 miles for every other reason on earth. So, to go to the grocery store, go on vacation, whatever it might be. Her actual expenses are listed as follows. So she's got gas, maintenance, interest, taxes, insurance, and depreciation. In addition, she pays $60 in tolls. 50 of those were for business trips. and $80 in parking fees, and all of that was while on business trips. So what is her deductible auto expenses under the actual method? Well, what we would do is take all those expenses that need to be prorated, so gas, maintenance, interest, taxes, insurance, and depreciation, and we would allocate that based on business use over total use. So you can see that business use was 8,000, total use was 13,000, so 62%. And then you just multiply each of those expenses by 62%. Well, since the tolls were unique, those are direct costs of doing business. Recall that $50 of those tolls were related specifically to business trips. You get to deduct all of that, and same with parking, right? Because those are direct costs of that transportation. So what would her deductible expense be under the actual method? Well, $8,066, right? Notice that that is going to be greater than the standard mileage method. So the standard mileage method, 4,000 and another 4,000 times the two rates in 2022 would be 4840. So in theory, she's going to want to take the higher of those two, and she would take actual. All right. So Carl purchases a car in 2018 for $50,000. He uses the car for both business and personal use. And over the years, he drives the car as follows. And you can see he's got business miles, personal miles, and total miles from 2018 to 2022. And he used only the standard mileage method every year. So therefore, he needs to calculate a basis adjustment for depreciation. So I've shown what the depreciation basis adjustments is for each of those years, times the number of business miles he drove. And you say, okay, well, he needs to adjust his basis by, the 100, the 1,040, etc., the 5,746. So the original cost of the car was $50,000. The sales price when he decides to sell the car, Carl sells the car for $20,000. Business use over the life of the car was 21.9. We can go back and see that. There's the 21.9, right? Total miles were 33.8. Whoops, sorry, wrong way. There's the 33.8 total miles. So business use percentage over the life of the car was about 65%. So when you sell a mixed use asset, a piece of property that is mixed use, you have to bifurcate that sale into the two parts. So that means you would need to allocate the amount realized between the business part, which is about 65%, and the personal part, which is the remainder. Same with the cost, right? You're going to allocate 65% of the cost of business and the rest to personal. And then you can see that depreciation adjustment goes only against the adjusted basis on the business side. So therefore, the adjusted basis is $26,000. You end up with a loss on the sale of about $14,000. That's probably going to be deductible, right? Because that's a business loss. Whereas the personal side, you can see there's no depreciation adjustment for that. The loss on the sale is about $10,500. That part, because personal losses are non-deductible, that means it is not deductible. That's the non-deductible loss. So you can see that this can get really complicated really quickly. All right. So Stacy works in her public accounting office in New York City. She typically commutes on the subway. That would, of course, be personal commuting costs. But during busy season, she often works until after midnight. And so the partners at the firm say, hey, Stacy, when it's late, we get it. It's not safe to ride the subway. You can just take a taxi, right? You can take an Uber or whatever it might be, and we'll reimburse you for that. And so even though that's covering her commuting costs, because it's reasonable for safety reasons for her to do that, then that's going to be deductible, right? That's going to be a deductible cost. I think that's a good place to stop. Yeah, before we do travel, let's stop right there. We'll nip this video.